Welcome to the third webinar of the Climate Finance ICCG webinar series. Today's webinar will focus on central banking and the transition to a low carbon economy, the role of monetary policy, and will be given by Dr. Alexander Barkawi. Dr. Barkawi is founder and director of the Council of Economic Policies, an economic policy think tank for sustainability focused on fiscal, monetary and trade policy. Prior to his decision to build up CEP, he was the managing director of some indexes and thus responsible for developing the Dow Jones Sustainability Indexes into a key reference point for sustainability investing. In that capacity, he drove worldwide marketing, sales and licensing as well as media and public relations for the DJSI family and other indexes compiled by Sam for more than 9 years. Before joining Sam, Alex took the lead in internationalizing the activities of Oikos, an organization that promotes sustainability in teaching and research of economics and management worldwide. Originally started as an initiative in St. Gallen, Switzerland, Oikos today comprises more than 40 chapters on 4 continents. Alex continues to be engaged in the organization as president of the board of trustees of the Oikos Foundation. So now I leave the floor to you, Alex, for your 30 minutes presentation, and that will be followed by 20 minutes of Q&A session. So I kindly ask to all the auditors to send their questions by writing in the GoToWebinar system, and we will try to answer to all of them, so please. And then, so I leave you the floor. Alex, please.
Thank you, Isabella, and thank you all for joining in. It's a tremendous pleasure to be with you this afternoon. Especially so as I believe the topic that you kindly invited me to focus on is a critical and yet very much neglected one. In fact, most central bankers would argue that there is no role of monetary policy in the transition to a low-carbon economy. I disagree, as you can probably imagine, with that notion, and thus greatly appreciate the opportunity to share with you why I believe that monetary policy should have a much more prominent place on our radar screens as we seek to advance towards a low-carbon world. Monetary policy, in a somewhat fascinating way, has not yet really hit our agendas with regard to low-carbon finance. In every other policy field, whether it's tax policy, energy policy, or trade policy, in every other policy field, the impact of climate change and policy support for a transition to a carbon economy are part of the debate. In contrast, monetary policy remains focused on a narrow set of goals, in many cases, in fact, on the exclusive goal of consumer price stability. And at the same time, we see significant amounts of money being created and allocated through monetary policy decisions. The 80 billion euro that the European Central Bank is currently injecting into financial markets on a monthly basis through the purchase of public and private sector securities are a case in point for that. 80 billion euro is more than 3 times as much as the monthly average of 24 billion euro in global clean energy investments in 2015. And yet we have nearly no debate in central banking circles whether there may be an opportunity to better align these injections with the objective of funding a low-carbon economy, whether some of the current purchases may in fact undermine that goal, and I'll come back to that later on, and whether even just a small share of these 80 billion could be targeted towards green finance. I continue to find this stunning. And with that as an example of the issues and amounts at stake, let me dig a bit deeper into the topic by first taking a look at the mandates of central banks, then sharing some perspectives on the instruments they use and the sector biases these bring along, before concluding with a few thoughts on policy implications. Allow me to do that with a disclaimer that there are many unknowns on this topic, and definitely many unknowns on my side, and that I therefore see my remarks today very much as an opportunity that I hope will trigger further debate and cooperation to jointly expand the knowledge base in this field moving forward.
Alex, sorry to interrupt you. Okay, we didn't see the slides. Okay, great. Now we can see them. Good. So
okay, great.
Sorry.
All right. Most central bank mandates are focused on price stability. Some include additional objectives such as maximum employment in the mandate of the US Federal Reserve. Many also include broader goals. The mandates of the Bank of England and the ECB that you see on this slide here are good examples in that context. The Bank of England Act defines that the objectives of the Bank of England shall be to maintain price stability and, subject to that, to support the government's economic policy, which in turn is to achieve strong, sustainable, and balanced growth that is more evenly shared across the country and between industries. Its mandate thus does not only provide the policy space to account for issues beyond price stability, but explicitly asks the central bank to do so. The Bank of England has taken a global leadership role in responding to this responsibility, also with regard to environmental issues. In fact, its One Bank research agenda, which was launched in early 2015, explicitly asks what role, if any, central banks have in addressing systemic environmental risks. And as many of you will know, the Bank of England has also been a pioneer among central banks globally in exploring the links between financial stability and environmental risks, in particular risks from climate change. Similarly, the ECB mandate starts with the provision that its primary objective is price stability. And it then continues, again similarly as in the Bank of England mandate, that without prejudice to the objective of price stability, the European system of central banks shall also support the overall objectives of the European Union, which, as you will see if you go into the Article 3 referenced in this mandate, include a high level of protection and improvement of the quality of the environment. And thus, again, the mandate does not only allow the central bank to think beyond price stability, but explicitly requires it to do so. Nonetheless, and regretfully, ECB representatives rarely mention this second part as they quote their mandate in public and frequently only make reference to their objective to keep inflation below but close to 2%. Central bankers also regularly give the impression that their policies have to be, and in fact are, sector neutral. They are not. And since they are not, we should have a transparent debate about the sector biases of monetary policy and possibilities to further align them with the broader goals we have, including those related to climate finance. Let me give you 5 examples. A key instrument of monetary policy are refinancing operations through which commercial banks obtain funds from the central bank. Often, such refinancing is structured through what is called repurchase agreements, where commercial banks provide collateral to the central bank to receive reserves in return, and where these commercial banks then commit to repurchase the collateral at a later date. Now, obviously, the definition which securities are eligible as collateral in these operations is an important aspect. In the case of the ECB, the list of eligible collateral includes several asset-backed securities, and these are some of them that you see on screen here, including several asset-backed securities based on car loans and leasing contracts, including, as shown on the right of this slide, a €1 billion asset-backed security issued by Volkswagen Financial Services in 2015, which securitized receivables from around 73,000 car leasing contracts. Clearly, having its securities on this list is a welcome feature for Volkswagen. Clearly, this is not sector neutral, and most probably, it is not aligned with the goal of a low-carbon economy that is at the center of our discussions here today. The ECB introduced another sector bias in June 2014 when it announced what it called a targeted longer-term refinancing operation, abbreviated TLTRO. A second series of TLTROs was announced just recently in March 2016. TLTROs give banks the opportunity to refinance themselves for periods up to 4 years for their loan portfolio to the non-financial private sector, excluding loans to households for house purchases. The exclusion of loans to the financial sector is aligned with the ECB's objective to ensure growth in credit to the real economy. With the exclusion of mortgages, the central bank reflects its concern about housing bubbles. Now, while focusing TLTROs on non-financials and excluding housing finance may make a lot of sense, it also shows that the ECB can, and in fact does, introduce sector biases in its instruments. Both exclusions influence credit allocation and thus echo the view that there may be a role for central banks to direct private credit creation away from certain sectors, providing guidance that could potentially be further aligned with the objectives of a low-carbon economy. The same holds true, and this will be familiar for those of you, especially from the UK, the same holds true for the funding for lending scheme that the Bank of England and the UK Treasury introduced in 2012 and then extended in 2015, which incentivizes banks and building societies to boost their lending to the UK real economy. It does this by providing funding to these institutions for an extended period with both the price and quantity of funding provided linked to their lending performance. And this is the important part here, with incentives to boost lending skewed towards small and medium-sized enterprises. This again is a bias towards a particular part of the economy, a bias that may make sense, but nonetheless a departure from the notion that monetary policy is neutral. Sector biases are also a feature of another instrument central banks have been using increasingly in the last years, and that have been hitting headlines all over the world, namely asset purchases. Whereas their usual refinancing operations, as alluded to earlier, are based on repurchase agreements and thus oblige commercial banks to take back the securities they provide as collateral. Asset purchases allow banks to sell these securities to the central bank and thus take them off their balance sheets. The so-called large-scale asset purchase program that the US Fed started in late 2008 is a case in point. It led to a quadrupling of the Fed's balance sheet, which is what you see as an excerpt on this slide here. It led to a quadrupling of the Fed's balance sheet to 4.5 trillion US dollars and to the Fed buying more than 1.7 trillion US dollars in mortgage-backed securities. A move that was obviously and by design tilted towards the housing sector. The background memorandum for a US Congress hearing in 2014 argued that the large exposure to mortgage-backed securities, and now I quote, arguably puts the central bank in the position of favoring certain sectors of the economy over the others. One of the experts at the hearing conceded that this is true, but was appropriate because the sector had suffered disproportionately from the crisis, and quantitative easing or asset purchases are more effective when undertaken in markets that are impaired. Similarly, and with that I come to the fifth example of sector biases in monetary policy. Similarly, the ECB announced plans for further asset purchases in October 2014 and has since then bought more than 1 trillion euro in government as well as corporate bonds. Again, with asset-backed securities, including asset-backed securities based on car loans, being among the eligible instruments the ECB can buy. Interestingly, just a few days after the announcement in 2014, Bloomberg already reported, and this is what this slide shows here, that commercial banks are seizing the opportunity to provide more car loans based on the announcement of the ECB. Now, there may be good reasons for the Fed to buy sizable amounts of mortgage-backed securities and for the ECB to buy asset-backed securities based on car loans. There may be good reasons for the Bank of England to support lending to small and medium-sized enterprises and for the ECB to offer refinancing operations that exclude the financial sector as well as house purchases. There may also be good reasons for other deviations from the notion that monetary policy is sector neutral. However, we should have a transparent debate about the sector biases resulting from these decisions. We should explore whether some of these biases are at odds with the mandate that central banks are asked to pursue. We should evaluate whether changes to the criteria that makes securities eligible for central bank transactions and others not can strengthen the alignment between monetary policy and the low carbon agenda that we care about. And finally, we should assess whether there is scope for targeted asset purchases and refinancing operations that would support funding to the low carbon economy. I'll come back to that point later. But before that, let me also emphasize that we need to tackle these questions not only with regard to the size of financial flows that central banks trigger, but also with a focus on the impact these flows have on interest rates. Interest rates play a critical role in the transition to a low-carbon economy, in particular because they have different effects on different energy technologies and thus on the relative competitiveness between renewables and non-renewables. The slide in front of you provides an example in this context. It is based on research by my colleague Pierre Monin, who calculated levelized cost of electricity per kilowatt hour across different energy technologies and interest rate levels. His results highlight that the competitiveness of renewable energy technologies goes up as interest rates go down, an effect that I would guess is also intuitive because it results from the fact that the bulk of costs for renewables lies in their capital costs, and that their fuel expenses, in contrast to fossil fuel technologies, are very low or even zero. And as a result, as outlined on this slide, the ratio between the costs of renewables and non-renewables goes down as interest rates fall. Or, to put it differently, renewables become more competitive as interest rates come down. And it's against this background that the role of monetary policy, its impact on financial flows and interest rates, is a critical one for the transition to a low-carbon economy. And with this in mind, let me conclude my remarks with 4 policy implications that guide us here at CEP as we move further into this field together with our partners. First, as mentioned earlier, the choice of assets that central banks buy and accept as collateral, as well as other criteria they set within the instruments they use, may not be sector neutral. Identifying such sector biases and mitigating them where they are misaligned with the objective of a low-carbon economy may be one of the most concrete short-term measures to take. A closer look at whether the ECB should really be buying asset-backed securities based on car loans and leases may be a good starting point in this context. Second, the current environment of ultra-low interest rates, together with significant asset purchases by central banks, could offer a remarkable opportunity to channel more capital towards a low-carbon economy and to pursue what several experts and policymakers have coined as green quantitative easing, or green QE. This proposal may not only be an option for those central banks like the ECB or the Bank of Japan that are still expanding their balance sheets, that are still purchasing assets in addition to what they already have, but also for those like the Bank of England and the Fed that want to keep the size of their balance sheets unchanged and are thus forced to reinvest the proceeds from maturing securities into new ones. Increasing the share of these flows, for example of the 80 billion euro in monthly injections from the ECB that I referred to earlier, increasing the share of these flows towards green investments could become an important driver towards a low-carbon economy, both through the direct provision of public money as well as a catalyst for further private investments in the field. The design of such a green QE program will require a thorough assessment of the underlying market structures and bottlenecks in funding low-carbon investments. It will require a detailed analysis to what extent the purchase of green bonds is an option for central banks, how much money could currently be absorbed through such low-carbon asset purchases, and how such purchases would actually change the funding situation for green investments. It will require a rigorous evaluation what institutional setup could underpin a green QE program, and whether, for example, in Europe, the European Investment Bank can play a leading role in that context. And it will require a solid understanding to what extent low-carbon investments face a bottleneck in debt or equity capital, and how a green QE scheme can account for that. A solid understanding of underlying market structures is equally important for the third policy implication, the analysis of targeted refinancing lines and of possibilities to apply similar schemes for low-carbon finance moving forward. If central banks can provide targeted refinancing operations for small and medium-sized enterprises, and for non-financials. They may also be able to offer such targeted refinancing for low-carbon funding. They may even be able to offer such targeted refinancing for low-carbon investments at discounted interest rates, a feature that could be particularly effective in view of the high sensitivity of renewable energy costs to interest rate levels, as mentioned earlier. Finally, it would obviously be hugely helpful if central banks were to include environmental considerations into their communication. Reporting on the possible relationship between their policies and environmental objectives would be a key contribution towards raising awareness about important interdependencies in their work. It would also provide an impulse, both within and outside central banks, to further assess the impact their policies have on the environment and vice versa, to expand the knowledge base on the effects of environmental developments on their core mandate. One idea that could be explored in this context is the development of a sustainability rating for the assets on central bank balance sheets. Sustainability ratings of portfolios are already an established feature elsewhere in the investment world. If pension funds and other institutional investors can evaluate their portfolios in terms of sustainability, it would appear that central banks can do this too, and thereby provide an indicator that could be tracked over time to assess their alignment with sustainability objectives. As mentioned at the beginning, monetary policy, in my view, in our view at CEP, should have a much more prominent place on our radar screens as we seek to advance towards a low-carbon world. And this is a good time to pursue this goal, because the expanding role of central banks and their move into unconventional territory has not only increased their influence, but also triggered a debate to review the mandates and objectives they pursue, as well as the instruments they use. The fact that the International Monetary Fund started a discussion about monetary policy in the new normal is a case in point for this. We as a community engaged on sustainability issues in general, and the transition to a low-carbon economy in particular, need to seize the opportunity that this development creates. Support for the transition to a low-carbon economy is not yet considered part of central bank remits and is only explored at the margins by monetary policy decision makers. Bringing light to this blind spot, identifying policy alternatives that can better align monetary policy with a low-carbon agenda and support financial flows into green investments is critical. I hope that many of you will join the growing community working on this issue, and I'm looking forward to the discussion. Thank you very much, and back to you, Isabella.
Thank you very much, Alex, for this is a very insightful presentation. So I would like to start with an interesting question from the auditors. The question is, do you believe monetary policies in other OECD countries like Mexico would need to be coordinated with European countries for the sake of the main low carbon objectives?
That's a tough one, because already without the reference to low carbon economy, it's already a tough one. Usually the mandates of central banks are fully focused on the individual countries. Coordination among central banks, and especially recognition of spillover effects of the actions of one central bank on the economies elsewhere, somehow are not yet high on the agenda and are subject to debate. I believe, that more coordination on any topic within monetary policy fields is warranted and important. And yes, certainly, I would also hope that more such coordination could happen with regard to what needs to be done for a low-carbon economy.
Great, thank you. Yes, I have a question myself. So, do you think that financial regulation constitutes an impediment to address environmental risks and, for instance, for renewable energy financing? I'm referring specifically to Basel III regulation.
Yeah, that's another hotly debated topic. It's in fact, interestingly, the topic that usually comes up under the headline of the role of central banks with regard to a low-carbon economy. Usually when people talk about that role of central banks, they look at the role of central banks as financial regulators and not at their role as decision makers with regard to monetary policy. I think indeed there are important links between financial regulation and a low-carbon economy, but I'm a bit more on the cautious side in arguing for a relaxation of regulatory positions with regard to low-carbon economy. If anything, I believe we should probably have stricter financial regulation to make financial markets more resilient, and this is what Basel III that you referred to, Isabella, is about. Now, certainly where such regulation is based on overly pessimistic assumption about risk and thus capital, as well as liquidity requirements for climate financing, reforms are warranted, and where it excessively, as some people argue, constrains insurance companies and pension funds to expand climate finance, it should be reviewed. But where financial regulation is driving up financing costs based on plausible risk assessments, I think this is a price worth paying for a more resilient financial system. And I would be very cautious to go back and relax these regulations.
Thank you for clarifying it, because it's very debated, these issues, and so it's a very good answer. Thank you. I have another question. So, what has been your experience with your work on this topic so far? So, how central banks are reacting to these issues that you described in the presentation?
I would say very cautiously. Now, we started working on the topic of monetary policy first from a different angle, namely the angle of social sustainability, and in particular the topic of inequality. So we've been looking at who wins and who loses from the types of actions that I was referring to earlier. Who wins and who loses when the European Central Bank pushes out 80 billion euro a month, or the US Fed invests $1.7 trillion into the housing market. These policies have distributive effects, and in our view, these distributive effects are not high enough on the agenda. Now, at the same time, we have seen central banks being open to that particular aspect of inequality and the wider topic of social sustainability in relation to their policies. And in particular, in terms of our work, we over the last 2 years were, for example, able to team up with the Federal Reserve Bank of Atlanta in 2014 and the Federal Reserve Bank of St. Louis in 2015 for 2 workshops to look closer at the topic of monetary policy and inequality, and we will follow up on that topic this year with a workshop together with the IMF that will take place here in Zurich in October. So this was our initial step into the topic, and this is where we've seen central banks, at least some of them, being interested and open to engage. Now, more recently, we have started taking up the types of issues that I talked about today, the environmental repercussions of monetary policy. I would say central banks in that field are a bit more hesitant to engage, but at the same time, we do see openings, and as I mentioned earlier, in particular, the Bank of England has really been a pioneer and at the forefront to putting these topics on the agenda. And it's also the Bank of England with whom we, this November, are organizing a work exactly on this topic of central banking, climate change, and environmental sustainability. In parallel, we've also been fortunate to engage with the UNEP inquiry into the design of a sustainable financial system, which I believe has done and is still doing fantastic work in identifying the policy interventions that would make financial systems more sustainable, and through them have also been able to reach out to some central banks and to build up the knowledge base about these links between monetary policy and environmental issues. So, I mean, in summary, central banks are opening up. I think they are increasingly also conscious of the fact that their actions have unintended consequences, if that's what you want to call it, or also intended consequences, and that they should contribute to better understand these links, and based on that understanding to explore whether there are alternatives that may be just as effective with regard to their core mandates of, let's say, price stability or financial stability, but at the same time help us move closer towards the goals of a low carbon economy in particular, and sustainability in general worldwide.
Great, thank you for the answer. Very, very complete one. So we have many questions arriving from the auditors, so I will start with this one. Does the Financial Stability Board Task Force on Climate-Related Risks work should continue on exploring active monetary policies by central banks in fostering the greening of the economy? Thinking in the G20 renewing its mandate.
So spontaneously, my answer is I would hope so, but as far as I understand, that would currently be outside the mandate of that group. The group that this question refers to has been tasked to come up with recommendations and principles to advance the disclosure of climate-related information from corporations. And I believe this is an important task. I think also that it will add to financial market resilience, and that it would probably help to increase financial flows to climate solutions. I do not believe, however, and maybe there I differ a bit from others, I do not believe that it will be a game changer. You know, there's so much excellent research on climate risks already out there that investors have not acted upon, that I doubt that additional disclosure will completely shift gear as further information becomes available. Now, that is what the FSB on climate change is currently working on. Whether I would love to see this mandate to be expanded, to have a broader discussion on the role of central banks in general and monetary policy in particular, absolutely yes.
Great. We have a question linked to the previous one. So can some of the central banks' role on financial system supervision induce commercial banks to also develop sustainability ratings of their assets?
short answer is yes, and we've seen some central banks, in particular in emerging countries, do exactly that. They require from the commercial banks to apply sustainability ratings to their assets in general and to their loan processes in particular. So in their role as financial regulators, obliging commercial banks to reflect on the environmental and I think also the social aspects of their actions is definitely possible, and I would say also desirable.
Good. Another question is, what monetary policy innovations, for instance, green quantitative easing, helicopter money, asset purchases, refinancing strategies, do you think hold the most potential to mobilize financing for a low carbon economy?
This is tough to say at the moment, and it's tough to say because I think what I alluded to earlier, we need to get a better grasp of the underlying market structures to really understand what are the interventions that would, for instance, de-block frictions and thereby increase flows. Let me give you a couple of examples. I think we need to better understand where there is a lack of funding supply in the field of low carbon finance versus a lack of demand for such finance. We are receiving different views on that question. Some people are saying, well, we have X amount of millions or even billions sitting there that we would like to invest into this field, but we don't find projects. And others are referring to lists of projects that are out there that are that would be profitable, but that can't obtain funding. So this is an important first step that we need to better understand. Then we need to better understand whether these projects face a lack of debt capital or equity capital. And the answer to that will be critical in designing the concrete types of schemes that I was alluding to before. If the impediment at the moment is a lack of equity, maybe getting the EIB, the European Investment Bank, to provide more debt capital wouldn't be that much help. And maybe as a final example, we also need to get a better understanding of the institutional capacity that we have. Just to share a number with you, the annual lending last year of the European Investment Bank was 77.5 billion euro. This is less than the 80 billion euro that the European Central Bank injects into financial markets in a month. And for the EIB, it was the annual lending. So that gives, I think, an insight also into the important question of capacity and how much money can be absorbed and then passed on to adequate projects. Now, that I think we should pursue all the four policy implications that I referred to. I think communication and expanded reporting from central banks would be a very important first step, not only to get more information on the topic, but also this is where the experts sit. The central banks are the knowledge hub on these topics, and I think without their engagement on these issues, it will be very tough to expand the knowledge base and build that solid foundation that we need to come up with appropriate policy alternatives. In a second step, I think, and I probably already mentioned that earlier, getting rid of sector biases that run against what we are talking here about, against the objective of a low carbon economy. Getting rid of these sector biases for me would be an important next step, because the existence of these sector biases contradict the widely held belief among central banks that what they do is sector neutral. It is not sector neutral, and we should have an honest debate about these sector biases and where these sector biases move us away from the other goals that we have, including climate change mitigation and a low carbon economy. We should really start thinking about how we can mitigate them.